The most successful people you know aren't just earning more than you, they're keeping more. And that gap isn't luck, it's strategy. While the average taxpayer scrambles every April with a shoebox full of receipts, the top earners in this country have already locked in their tax position months before the year even ends. We're talking about people who treat the tax code like a treasure map, not a punishment notice, and they found exits you didn't even know existed. The IRS tax code runs over 70,000 pages long, and the wealthy don't hate that number, they love it. Because complexity is where the loopholes live. Here's the mindset shift that changes everything. High earners don't think about taxes in April, they think about taxes in January of the prior year. They're playing chess while most of us are playing checkers. And by the time tax season arrives, their game is already won. The engine behind all of this is something called proactive tax planning, which basically means engineering your income, deductions, and entity structure before the money even hits your account. Think of it like a river. Once the water flows downstream, you can't redirect it. But if you build the channels first, you control exactly where it goes. One of the most underused tools in the high earners playbook is entity structuring, specifically the S corporation election, which can legally reduce self-employment taxes by tens of thousands of dollars annually. Most people running a side business or freelance operation are essentially handing the IRS a tip they never asked for, simply because they chose the wrong business structure. Then there's the concept of income timing, where successful taxpayers literally choose which year to recognize certain income based on projected tax brackets. It sounds almost too simple, but deferring a bonus or accelerating a deduction can swing your tax bill by 5 figures, legally, cleanly, and with zero drama. Real estate investing gets its own hall of fame in tax strategy, thanks to depreciation, cost segregation studies, and the magical phrase passive losses. A well-structured real estate portfolio can generate paper losses that offset real income, which is exactly why so many wealthy professionals suddenly become very interested in rental properties around year 10 of their career. Now here's where people get it wrong. They think this is only for the ultra-rich, the Bezoses and Musks of the world with armies of accountants. But the reality is that business owners earning $200,000 a year can access most of these same strategies if they're working with the right team and the right timing. The misconception that deductions are sketchy keeps middle-income earners from claiming what's legitimately theirs. And that fear is ironically one of the most expensive beliefs you can hold. Legitimate deductions for home offices, vehicle use, health insurance premiums, and retirement contributions are not gray areas. They are features of the tax code designed to be used. Speaking of retirement, maxing out tax-advantaged accounts like a solo 401k or a SEP IRA is one of the cleanest, most straightforward moves high earners make every single year without exception. You are essentially choosing between giving money to the IRS today or investing it in your own future, and the math on that decision is not close. The pattern across all highly successful tax planners is discipline. They meet with their CPA or tax strategist at minimum quarterly, not annually. They're not reacting to the tax code. They're anticipating it, adjusting their moves the way a coach adjusts a game plan at halftime. And here's the philosophical truth underneath all of it. Wealth is not just about how much you make. It's about how much of what you make you actually keep and deploy intelligently. The investor who earns $300,000 and keeps $220,000 will always outpace the one who earns $400,000 and keeps $200,000 because retained capital compounds, taxes don't. So the actionable takeaway right now, today, is to stop treating tax planning as a once-a-year event and start treating it like a financial discipline that runs parallel to every business decision you make. Moderate your risk, size your strategies appropriately, and never let urgency or ego override a well-designed process. The calm, consistent player wins this game over time. Whether you're just starting to build wealth or you're already deep in the game, the moves you make now in structuring, saving, and positioning will echo for decades in your net worth. Discipline, sizing, and consistency aren't just investing principles, they're tax principles. And the people who internalize that early are the ones who retire with options. If you're ready to stop leaving money on the table and start building a smarter financial foundation, check out our links in the description below. Whether you're exploring real estate investing, need contracting work done, or want to connect with the right lenders, we can help you get started.